It's time to introduce our first speaker, Deborah Fuhr. And let me tell you, we are giving it a hybrid start to this conference. Deborah, in fact, is joining us live on Zoom over here. So let's have all your eyes on the screen. And let's bring on board none other than Deborah Fuhr. Oh, good morning indeed from India. Deborah.
Yeah, good morning from London. It's early here, so great to be with you. So let's kick it off. I think the first thing I would say is, what is active and what is index? Because I don't like the term passive. Passive implies that you're not doing anything. So index is a better way to describe these products. What we find is many investors are employing a barbell approach to investing. So where they find active mutual funds, where they feel they can pick stocks or bonds, they will use them. But on the other side, what they find is where they don't know a good active fund or don't feel they can pick bonds or equities, they are going for index products. And we know that getting your asset allocation right delivers 90% of the variations in your returns. So index is not the enemy. Index is a tool to help you do job for your clients. And what we have also seen is that performance matters, and it's actually quite challenging to find active mutual funds or even hedge funds, for that matter, that consistently deliver alpha. And I will show you a slide in just a moment. The other thing we know is that over the long run, lower cost products will, on average, deliver better returns for your clients. We also know that one of the big changes that has happened in India and many countries is the payment to advisors to sell products has changed. And so in an environment where advisors are paid to sell active mutual funds, they do that. Where those commissions or retrocessions go away, we find that they do open up their minds to the idea that index funds and ETFs can be useful. And so that idea that they can be a solution, I think, is very important. What we are seeing globally is that many people don't know how to talk about finance, and they go to robos to learn how to think about investing. And most robos are using ETFs as the tool to allow for asset allocation. And so people become a bit familiar with the idea of asset allocation and with ETFs. So I do think there are some wins pushing people towards the idea that index is not bad. When we look at the performance, as I told you, and if you were to look kind of in the middle bottom of the right side of the screen, you can see India. And what this is looking at is how many active funds did not beat the local benchmark. And what it's saying in the past year that 86% of active funds did not beat the benchmark. On a 3-year basis, 87%, and on a 5-year basis, 83%. So that illustrates how it is challenging in almost every market around the world to find active funds that consistently beat their benchmark. And so for many, using low-cost index products can actually be a very useful way to think about investing, at least in some markets. And I think we've seen professors, Burton Malkley has basically said, a blindfolded monkey throwing darts at a newspaper could select a portfolio just as well as someone carefully trying to select securities. And he's the person who wrote The Random Walk Down Wall Street, so a highly respected person. I think another person I will point to is, surprisingly, Warren Buffett has told his wife and his trustee that he feels investing in some bonds and then an S&P 500 product makes a lot of sense. And he feels that for both investors, institutions, and retail, investing through an index fund that charges lower fees is the best approach to investing in the equity markets. So having said that, I've been involved with the ETF industry since 1997. So you heard I was at Barclays and BlackRock. Before that, I spent 11 years at Morgan Stanley. So when I got involved with the ETF industry, there were only 21 products with $8 billion. At the end of this past year, the ETF industry now has over 10,000 products, $10.3 trillion. And we find that over 5,000 institutions are using them, retail investors, financial advisors, and fund selectors. And the reason for mentioning that is ETFs are a form of not just index, because you can have active ETFs, but most of it would be index. When we think about it, one of the unique things about ETFs, and you did hear that in the introduction, is they are being used by institutions. So institutions were the first to start using ETFs. But what we have seen over the years is that financial advisors and retail investors are using ETFs quite significantly. And the other change we've seen is it's moved from traders to portfolio managers to even fund selectors at mutual fund houses are including the selection of ETFs. And one of the unique benefits is ETFs, you're getting the exact same toolbox that pension funds, hedge funds, and asset managers use at the same annual cost with a very small minimum investment size. So it really is the only democratic investment product out there. And when we think about how are people using them, many mutual funds use ETFs to equitize cash. So in a rising market, rather than sitting on cash, you'll find that many mutual funds will invest in ETFs. And that way, if they have drawdown, they can easily sell the ETF and not have to impact the portfolio of the mutual fund they're running. We also see that many investors use ETFs as a core holding and then will actively invest in securities around that core holding. For others, they will use ETFs as satellites. So you can invest in an ETF to invest in sectors, you can invest in smart beta, you can invest in themes, you can invest in ESG, you can tilt towards fixed income, commodity. And I guess the other thing I would say is today there is a little bit of a debate when I say, there's index and there's active. When you think about index strategies, many people would say smart beta is kind of sitting in the middle of between index and active, because smart beta strategies are picking factors that over the long run are academically shown to deliver better performance than market cap. So you have things like size, value, momentum, quality, min-vol would be those factors. So for many investors, they see this as active management, even though it is tracking an index. So how you define active and how you define index is really left to you in terms of, in your mind, how does it work? We also see that many people like to play sectors. And so doing sector rotation with an index product where you're going to get the index makes a lot more sense than trying to do it through active. You can use ETFs to move from one strategy to another. A thing we're seeing globally is many people are moving away from market cap benchmarks to ESG. And this makes it very easy if you're using index funds or ETFs to do this. We also see that for many investors, gaining exposure to emerging markets. So being able to invest in India for foreign investors, ETFs have proved very popular because it makes it very simple. They're buying one security, it trades and settles like anything in their home market. I know in India, you have ETFs that allow you to get exposure to, say, the US market. So it makes it very easy for you to not have to worry about getting permission to invest outside of India. We also see that increasingly, many people are using ETFs within model portfolios. And so the idea that you would have low risk, moderate, dynamic, you can come up with other strategies. These tools are becoming popular really globally around the world. I also would say that one of the things we saw during the COVID period, if you look at the US, which often drives some of the trends that are happening, we saw that in 2020, the growth in the number of investors in the stock market in the US was 15%. So we had 15% of the investors being new investors. And these investors were more optimistic, and most of them were using ETFs. They found them an easy way to play themes. We have ETFs that allow you to play work from home. You can play disruptive technology. You can play healthcare themes. So a lot of people were watching the news and using ETFs as a tool to gain the exposure to the sectors and styles that they thought would perform better over time. Whoops. When we look at your market, what we can see is, and I've taken these two slides from the Money Center, you can see that the growth in the use of index funds and ETFs is actually moving quite quickly. We see that I think the government using ETFs as a way to disinvest some of their holdings has actually given encouragement to investors to use ETFs. And we do know that your employment retirement fund is putting money into ETFs at a rate of between 5 and 15% of deposits. And that's been happening since 2015. So I think for many investors, ETFs are not the enemy, but they're really a tool to allow you to help your clients gain the exposure to the right asset classes and the right mix of countries or sectors. We can also see that the growth in retail use of ETFs has gone up significantly and continues to go up. And so I think it's been a combination of regulatory changes that have made advisors look at it, the changing performance of mutual funds and the recognition of this in the press. I think you have a number of media outlets that write very good stories about performance of different index funds, active funds, and ETFs that help to raise awareness of how you should be thinking about investing for the long run or even for the short run. And I do find that for many investors, it's the fear of trying something new. And I would encourage you to look at the use of various products and talk to the issuers, because I'm sure there are a lot of the providers of both active and index products and ETFs in the room. If you were to look, the Nifty 50 ETF assets have grown to 2 trillion. And we've seen that in 20 months, it's gone from 1 trillion to 2 trillion. So that's very quick. And it accounts for the Nifty 40% of total passive funds in India. There's 17 ETFs, there's 19 index funds, and there's even 7 ETFs outside of India providing exposure to the Nifty that are very important. And we know that 3/4 of the assets in the Nifty are from the Employees Provident Fund organization. So I do think that that should give you comfort that using ETFs is something that does make sense. It's embraced by the government. Last year, I hosted an event virtually, and I had one of the regulators from SEBI speak, and she was actually quite positive, talking about how when you can't find active mutual funds, investing in low-cost index or ETFs makes a lot of sense for investors. So the regulator, at least last year, was quite optimistic on how ETFs can fit into someone's portfolio. So the idea is use the products that you feel can add active. Where you can't find active, be open to thinking about using low-cost index products to create asset allocation where that's where you're generating your alpha. So index is not all about being passive, and that's why I don't like using the word passive. It's really about the idea that they are tools to provide exposure to an index such that you can deliver value to yourself or to your retail clients. I've left a little bit of time for questions in case there are some from the audience, given I did get up early this morning to talk to you. So maybe I could stop there and see if there are any questions that anyone might like to ask.
Thank you, Deborah. I'm just going to quickly check with our members of the audience if there are any questions. I'm going to request you to please raise your hands. We'll have the mic passed on to you.
Deborah, one question to you. Given the fact that index funds and ETFs are turning into commodities, how does one choose one from the other?
That's a great question. So I think what you want to do is look at what's inside of it. Clearly, if it's the Nifty and it's fully replicating, there's not going to be a lot of difference in terms of what's inside of it. But then you'd also want to look at the size of assets. For many investors, if you're a large investor, you will have limits that your investment can't be more than 10 or 20% of the assets in the fund. So size does matter. You want to look at the annual cost, because if there are significant differences, buying the one that's less expensive will over time deliver better returns. But I think if you're looking at products that have different benchmarks, then you might want to look at, what is inside of it? What are the differences in the securities? When we start looking at things like themes, sometimes the themes have a lot of weights to very big tech companies, while others will be more focused on the pure play exposure to those themes. And so looking at what companies and the weights is very important. When you look at commodities per se, internationally, we have some products that are buying, say, physical gold. Some will be buying futures, some buy front month futures, and some buy forward. So understanding, are you buying gold mining companies? Are you buying gold? Or are you buying different futures will deliver very different returns for you. So making sure you understand what's inside of the tin and what is the structure. So sometimes products will be structured as mutual funds. Sometimes they're structured as notes or commodity pools, which will imply different counterparty exposure, regulatory treatment, and also tax treatment. So I think understanding the basics and what's under the hood is one of the best advices I can give you. So I would encourage you to go to the issuer's website if you are an advisor, or if you're a retail investor, then speak to your advisor and make sure you understand it. And then think about how, when, and where to trade. So there are best practices. So make sure you understand what are the best practices when you want to put money into an ETF and also when you want to take it out.
Thank you, Deborah.
Hi, good evening, Deborah. This is Anil Punjabi from Mumbai. The market follows its own course. There are times where only the large cap moves. There are times where small cap moves. There are times where nothing moves, right? And how does one manage it when using an index fund? Because when I give money to a diversified fund manager, I totally entrust him. Suppose you decide whether it's small cap, large cap, micro cap, that's his call. How would that be managed? If I give it to him, say, put it in Nifty, and tomorrow now we know we are entering a situation where maybe the market may not go anywhere. I'm just making an assumption here. Then how would the index outperform in this case? There would be individual stocks which would do well. So that's where you need a fund manager to pick the things. Sorry, I'm coming from the active scam, so there's a bias in my this. So please address this. Thank you.
So I think for many people, holding the market and holding on and staying calm through volatile times will deliver better returns. I think for most people, it's very hard to time the market, when to leave and when to come back. And often people miss the best time. So often a few days will deliver the best returns over many years. So for most people, it would be go to someone who can help you create a model portfolio of asset allocation that makes sense for you. And if you find that one component and rebalance occasionally, so whether that's quarterly, 6 monthly, or annually, you would rebalance back to your benchmark targets. I think for many investors, that makes a lot of sense. And just because it is very hard to time the market. So pick a strategy that is giving you diversification and that allows you to benefit over time. Unless you're a great stock picker or market timer, which there's not many, it would be hard to do what you're saying, because we can see that in the numbers where for many active managers, it's hard to do that. And some might be able to do it, but unless you can find those people, you'd be better off holding a broadly diversified index portfolio over the long run, or a combination of active plus index over the long run.
Thank you, Deborah. Let's take the next question as well.
Hi, this is Saket from ETF Junction. Thanks, Deborah, for this wonderful insight on the global as well as Indian ETF market or passive market. As we have seen a meteoric rise in the USA ETF market or the index market, right? We are seeing something similar happening in India. What are your couple of suggestions for investors and advisors at large to be looked into for such kind of a growth to happen?
So what we are seeing is investors right now are concerned about inflation. And so for many investors, what we've seen in terms of where the money's going, this year we're seeing many investors putting money into gold. They see it as an inflation hedge and a safe haven, especially because we do have concerns around supply chain, the war in Ukraine. So I would say this year flows into gold through the end of April have been $22 billion globally, last year at this point, they had outflows of 7 billion. Up until April, we were seeing the majority of money going into equities and a lot of it going into the US market. In the month of April, we saw that equities had slight outflows and that investors were putting money into fixed income. So we are seeing some people looking at inflation hedged bonds. We're seeing others moving into the safe haven of kind of shorter term government bonds. So I would say generally those are the trends that we're seeing in the market. In addition to, we still see some investors looking at making that transition into ESG. We do have regulations in Europe causing that trend to actually accelerate. So I think those would be the types of trends that we've seen in the month of April in terms of where people are putting money to work. And it is impressive because the global ETF industry has had net inflows, so creations versus redemptions now for 35 months. If you were to look at active mutual funds, you have not seen that number of months where money net keeps going in. So we are seeing increasingly people are finding ways to augment or build portfolios using different types of ETFs.
Thank you very much. Well, ladies and gentlemen, on that note, we call it a wrap. So firstly, can we have a huge round of applause to thank Deborah for sharing her valuable insights with us. Thank you so much again, Deborah, for joining us early morning indeed to share your valuable insights with us.